A bull call spread is one of the 4 vertical spread options trading strategies that we're going to cover. And although it's a little bit dull and boring of a topic, trust me, I know, because it's been boring making this video, but you know what's not boring? Cashing in on these options trading strategies, which I will also show you in this video. So let's get right into it. What is a bull call spread and when should you use it? Well, if you have conviction that a stock is going to move to the upside by a limited amount, a bull call spread is an optimal option to use as far as options trading strategies because it gives you leverage. Now, what is the advantage of a bull call spread? Well, the advantage is you are going to be minimizing the amount that you could potentially lose. However, the trade-off is you are also putting a cap on how much you could potentially earn. So basically, you're buying a long call option with a specific strike price while at the same time buying a short call option at a higher strike price. Now, I know it's not very easy to have an understanding of this without actually seeing it in practice. So I went ahead and I followed my own bull call spread options trade that I just took screenshots of. I'm going to explain to you the gains, the losses. We're going to look at a P&L graph. That's going to tell you exactly the range where you are making money. What is your break even? When are you losing money? What do I mean by you're capping your profits at a certain amount? What do I mean by you are minimizing the potential losses? We're going to cover all that and more. All I ask in return, like the video, have a comment below on what you wish for me to cover next. Any question you have about this video, mention in the comments because this channel is still small. I'm going to respond to every single comment that I see in the comment section. With that being said, let's dive into the nitty and gritty of bull call spreads. Okay, so this was a type of debit vertical spread called a bull call spread. So take a look at exactly what I did here. I went ahead and I bought a call option expiring December 23rd, 2022 at a strike price of $305. This was an out of the money call option. And at the same time, I went ahead and I sold a call option also expiring December 23rd, 2022, but this time with a much higher strike price, $320 strike price. And so about a day later, this is what my position looked like. Netflix sank in price. So as you can see here on the call option, I was now down $1,042. But because I sold a call option at a strike price of $320 and now it's getting closer to that, then the gain on that option was $683.92. So I was down 40.29% on the call option that I bought, and I was up 44.06% on the call option that I sold. And now I think it'll make a little more sense when I show you the executed orders in my account. So don't worry about these two that happened in October. I already made a video about it where I went ahead and I bought call options and I basically 3x'd my money. But the one I want to discuss here is the bull call spread. And I want to explain why it says $3.44 debit here. So take a look here. Right here you could see that, again, I bought the call option and I sold a call option that had a higher strike price so that I could go ahead and minimize the risk. Because me personally, I would have went ahead and closed out the long call position if the price reached somewhere around $320. So it makes all the sense in the world for me to go ahead and write a call options. So sell option contracts so that other people can buy them way out of the money for a $320 strike price, thereby minimizing my risk and taking away from how much I am actually paying because I'm getting money into my account when I sell a call option, but I have to spend money on a call option. And obviously, I spent a lot of money here. But because I sold a call option, I could go ahead and deduct that from the principal that I'm spending. And you could see all of that right here. So we're going to explain this very, very slowly. So check this out. When I put in this bull call spread,
I bought 3 Netflix December 23rd, 2022, $305 strike price call options. That would have cost me $8.62. Now remember, an option contract, you have to multiply by 100. So actually one of these option contracts would have cost me $862. However, I sold call options as well, and that money went into my account. And how much was I able to sell these for? $518. So you have to take the $862 that I would have paid, then subtract the $518 because I went ahead and sold options to other people that bought it right away, and that gives us a debit of $344 an option contract. And so again, I want to reiterate that if I just did this trade, it would cost a lot of money. It would be $862 per option contract that I'm buying. However, because I did a bull call spread, it only cost me $344. And that's why it says $3.44 debit. Because again, it's taking this number that I spent money buying, subtracting it from this number because this went straight into my account. And you can actually calculate how much this entire trade cost me because since I bought 3 options contracts, we simply multiply 3.44 times 100, which is $344 times 3 because there's 3 options contracts. And that would give us this number right here, $1,035.11 that I went ahead and spent on buying the call option and then selling a call option with a higher strike price. Again, why did I do this? To minimize the risk. Yes, I am capping the amount I could potentially make because remember, if I just bought this call option and did not write a call option and the price of Netflix went to $500, I would have made some really impressive gains. However, when you write a call option at a higher strike price, you're capping the gains you can make to whatever you would have made if this call option, the underlying stock, went to $320. And so there's a give and take with all of these option contract strategies. Now, the take is that I limit the amount of profits I can make up to Netflix stock price going to $320. And for that, I'm also minimizing my risk because if this trade goes completely wrong, rather than $862 times 3 I'm losing, the maximum I can lose is $1,035 because that's what I spent on this trade. And that's the trade-off. And as you can see, I'm minimizing my risk by over 50%. So I know that the last thing you want to see is a P&L graph or risk profile. There's a couple of different names for this that you see when it comes to options trading strategies, but it's really important to point out, and I want to show it to you as it pertains to the Netflix bull call spread strategy that I put in place. So if you take a look here, as I showed, the most that I could lose on that trade is $1,035, and that's designated with this. So remember that this part here, that's going to be your profit loss, and this chart here is going to be dependent on the underlying price of Netflix in my bull call strategy at expiration. And so something I want to point out is that this part here where you're starting to see an incline and then eventually profits, that occurs at the strike price of the long call option. And over here, you're going to see that where it plateaus and you no longer can make that exponential profit. Remember, we talked about that. That was the trade-off, that you can't continue to make this exponential profit. And that's why your losses are capped to here, but also your gains are capped to the underlying stock price being the same or more as the strike price of the short call option. And over here is going to be the break-even price, usually somewhere in the middle between the strike price of the long call option and the strike price of the short call option. So you can do the math in your head sometimes to see what you would need the stock price to be trading at expiration. That's if you're planning to hold this to expiration in order to break even. And so bull call options is definitely something that you should take a look at. Now, an interesting thing happened here where Netflix share price kept sinking in value, and it happened really quickly after I bought this bull call spread. And as you can see here, my total gain was starting to be pretty high on the call option that I have written. I was up 44.06%. And so I did something pretty smart in this situation. I went ahead and I closed out that position where I sold call options on Netflix with a $320 strike price. What does that mean? Well, I sold those options to someone. Those options were now worth a lot less. So I went and bought them back out and closed out the position. And I was up like $750 just on that position. But what does that mean? Well, it means something really interesting here, because as you can see that the December 23rd, 2022 $305 call option is now, I'm up over 40% on it because the price of Netflix started to run up. Again, the reason I went ahead and bought a bull call spread on Netflix is because they had great earnings, in my opinion, really good earnings. And the stock price ran up a bit and then it sold off again because of the broader market or because a lot of investors were locking in gains, and it sold off too much. And I knew based on technicals and fundamentals, I had really strong conviction that it's going to test $300 and above $300 again. And so it made all the sense in the world for me to buy out of the money call options. And so what did I do? Well, this other trade that we were seeing below this trade where I sold call options at a $320 strike price, I went ahead and I cashed those in and I made $700. And I did the right thing because then the price of Netflix rose and went up. And I started making a lot of money on this call option, whereas at the same time, I would be losing it on the options that I sold. Because remember, when you sell options, you are taking basically the reverse conviction position, where if the stock price rises, you are going to be losing more money on the options that you wrote. And so I cheated the bull call spread where I went and closed out the position where I had sold a bunch of options contracts, and I just left a basic long call option. And if the price of Netflix continues to climb and goes well above $300, $305, I'm going to be sitting on massive gains, and those gains will no longer be limited by the call options that I have sold. And so now I'm just sitting on a classic call option scenario. And as you can see here, over the past 5 days, Netflix shares have risen 11%. And over the past day, they've risen 5.5%. So I made an excellent choice about closing out that position where I had sold Netflix shares, and I'm only holding on to the position where I have bought long call options because I have very bullish sentiments on Netflix shares. Now, yes, I still don't think it's going to go over $320. However, because I locked in gains of more than $700 on the option contracts that I've written in the bull call spread, I can now take full advantage without my gains being minimized because of the writing of some of those call options that I've sold. And so that is an interesting scenario. It doesn't make it a classic bull call spread. It was in the beginning when I showed you the trade in the beginning. That was a classic bull call spread, but it's just to show that you don't always have to hold it until, close to the expiration date and sell out your position at the same time. You can play with it based on the situation, how the market reacts, and your conviction. Hopefully this taught you guys a little bit about bull call spreads. Let me know in the comment section if I did a good job explaining it. Let me know which topic you wish for me to cover next, and I will see you all in the next video.